Research, where he headed up the group's quantitative research efforts. He also designed and traded some very large and profitable strategies based on supply and demand factors for top-tier hedge funds. Frequently quoted in Forbes, Financial Times, Wall Street Journal. Apparently he's also an expert, subject matter expert on asset allocation for the Level 3 program at the American College. In 2013 was awarded an editorial prize for his in-depth study of the European debt crisis. And I do want to note, in 2012 made a very good and bullish call on the European market. CFA charter holder, 2 master's degrees, 3 languages. I'm feeling a little bit inferior. Please welcome Vincent.
With an intro like that, you've done the same thing for European equities. You raise expectation, you set me up to failure here. Thank you all for joining. It's great to see so many people attending a presentation on something that is somewhat distant from the beautiful Pacific Northwest. But I'm afraid that Europe is going to remain on the map for quite some time, and it might be with us in the news, mostly in a negative way for the coming years. So I think it is important to take some time and think about European equities as we head into 2015. So I'm going to start with a presentation should last about 30 minutes, and then we'll do some Q&A. The presentation will really hit on the topics that I'm sure are top of mind, which is deflation, QE. Now, I prepared this before the latest Draghi announcement, so I think we can address many of these things during Q&A if I don't cover enough. So, what I wanted to start with and was really a broad macro perspective and more secular factors, because I think it's important that we have them in place before we look at possible opportunities in Europe. And I also specifically think that there are 3 areas in European equity markets where the consensus is wrong. And understanding how the consensus is wrong can really help you not make mistakes during 2015. The first area, which I think is understood, is deflation in Europe. I mean, if you go by Bloomberg or the ECB press conference, deflation is viewed as mostly a cyclical and monetary problem. We had austerity following the debt crisis. The ECB balance sheet has compressed because of the repayment of LTRO. So it's basically your good-old monetary equation, MV equals PT. M is shrinking, P is shrinking, you need to get P up, let's have QE, and everything will be fine. The idea is that deflation can and will be solved by QE. I think this is incorrect, and this does not account for the specificity of the European Monetary Union, which is essentially a currency union without fiscal oversight. And my thesis is that deflation is a structural product of the monetary union, not a cyclical thing that you can fix with QE. To do that, I need to maybe go back in history. Bear with me. Go back to 1991. It was the Maastricht Treaty in Europe, which laid the foundation and the institutions for the European Monetary Union as we know. 1991 is 2 years after the fall of the Berlin Wall. And the fall of the Berlin Wall was a threat to Europe. It was about to expose the lie that Germany and France were equal partners. You know the quote, Europe is here to hide the strength of Germany and the weakness of France. Well, and I know something about the weakness of France. When the wall fell, it was clear that Germany would dominate Europe. And At the time, there was a deal between Helmut Kohl and François Mitterrand that France would not oppose reunification upon the condition that Germany would join the euro. Now, Germany was not interested in the euro initially. Germany loves the Deutschmark. I mean, people still give each other Deutschmark for Christmas in Germany. I mean, the Deutschmark is, no, it's emotional. It's a symbol of, you know, the resurgence of Germany after the dark years of the war, and it's an anchor of stability. Why did Helmut Kohl give out the Deutschmark? He did it because he obtained from Mitterrand and Jacques Deluard, the commission man, that the new currency would not be inflationary for Germany. For the average German, inflation would stay the way it used to be back in the German days, i.e., inflation in Germany would remain lower than the rest of the Union. Germany didn't want to get the kind of inflation rates that Italy or Spain had. So when we started the Union, in 1998, when the ECB was launched, we had a formal charter, a mandate, keep price close to but below 2%. And then we had an informal mandate, keep German inflation about 1% lower than that. So you can think of the ECB as having a menu with 3 items and you can only pick 2. The 3 items are inflation in Germany, inflation in the rest of Europe, and inflation in the Eurozone. You can pick up 2 targets, you have to let go of the 3rd one. For the first 10 years of the Union, we picked inflation in the Eurozone and inflation in Germany. First 10 years of Eurozone, we had about 2% inflation in the Eurozone, 1% in Germany, and then we let go of inflation in the South, Spain, Italy, and so forth. But of course, if you do that for 10 years, Italy, Spain, and Portugal are going to lose competitiveness, grow current account deficits, take on too much debt, and then at some point the market will no longer take it and you have a crisis. So that's 2010, 2012. Since 2010, we need to reverse that spread between inflation in Germany and the rest of the Eurozone. We need inflation in Italy and Spain to be significantly below that of Germany. Now, Germany is not going to accept a higher rate of inflation. It's not their fault, right? It's all these lazy Catholic Southerners. So the only way you can target these 2 ones is if you let go inflation in the Eurozone. The only number that makes sense for in the new monetary equilibrium is to have inflation of maybe 1 in Germany, deflation in the South, and about 0.5 in the rest of the Union, on average for the Union. And that's where we are now. I mean, you take out the energy thing, core CPI has been about 0.6, 0.7 all along. And that's why the ECB hasn't been acting all that much, because the current number is the only one that makes sense. And I think the big discovery of the market of 2014 was that 2% target that we had was not serious. The true ECB target is much lower, and the market will price for that. So one way I like to think about the EMU is to remember, you remember that before we had the EMU in Europe, we had something called the European monetary snake. So all the currencies were pegged to the Deutschmark, and because the Germans were more productive than everybody else, every 2 years or so we had to revalue the lira, the peseta, the French franc, and so forth. With the euro, we set up disparities in stone. Cannot do that, cannot depreciate anymore. So we have a new monetary snake, but it's a deflationary snake, and we are all pegged on the German CPI. And every country in Europe that is less productive than Germany, which is every country in Europe but Germany, has to compensate by having lower wage growth than Germany. So we all peg to German CPI. So if you want to understand what happens to inflation in Europe, you need to look for the head of the snake, which is German CPI. Which takes me to the second chart here, which is I took from your econ textbook, Econ 101. You remember the Phillips curve. There's a trade-off between inflation and unemployment, right? You can, if you have a high inflation, you have low unemployment, and vice versa. Wow, look at what's happening in Germany. Positive relation. Germany, since 2004, was able to simultaneously decrease inflation and unemployment. Inversion of the Phillips curve. How did that happen? It was a program of reform called the Hearts for Labor Market Reforms. So it was back when Germany was a Sigma of Europe in the early 2000s. Spain was doing great, Italy was doing great, and Germany was doing poorly, Gerhard Schröder, the Social Democrat chancellor, had a very harsh package of structural reforms called the hard-skill labor market. It included the creation of what's called mini-jobs, where essentially you get no social protection, very flexible contract, very low pay. It included a program of guest workers, where you could take workers from Poland and Czech Republic, have them go work in Germany under Polish contracts and underpay them. Basically, what Gerhard Schröder did is he broke the power of the trade union in Germany. And maybe it was a good thing, who knows. The result of that was that Germany regained competitiveness. And GDP picked up, unemployment dropped, but at the same time, wages went down because we were doing all these labor market reforms. Germany has been understaffed for about 10 years. Hard-skill was announced in 2004, which is when I started the company. We are now here with record low unemployment in Germany and no inflation. This may be over in Germany. I suspect there is a chance that we're going to get the minimum wage next year, so maybe the deflationary impact of hard-skill is over in Germany. But because of the nature of the monetary union, this deflationary shock is being exported all over Europe. Because we are all pegged to the CPI, we basically all have to go down the path that Gerhard Schröder took for Germany 10 years ago. And if it took 10 years for Germany to do it, I think it might take a good 20 years for France to do it and 40 years for Italy. So this will take time, and this is what's driving deflation in Europe. It's structural reform within a currency union where you have vast differences in productivity between member states and no way for assets to be fiscal transfers between the member states. So all the adjustment must be borne on real wages. That's what drives inflation, not lack of liquidity. And I'll talk more about that, but if you're trying to cure this problem with more ECB money, it's not going to work because you're targeting the wrong piece. Let's switch on to another area where I feel the consensus is wrong about Europe, which is oil prices. Now, I'm sure you've all heard on CNBC people say, well, lower oil prices are a stimulus for the world. QE for the people, and etc. And Europe should be the biggest beneficiary, right? Because Europe is a big importer of oil. I don't think this is correct. First reason is just energy efficiency. If you divide GDP by oil consumption, which I'm doing here, you see that Europe is the most energy efficient region in the world. So all else equal on a relative basis, low oil prices will benefit the dirtiest countries, which will be China, India, even the US, but Europe will benefit the least, like just math. The second reason is on the index composition level. Europe, energy and basic materials are a huge part of the index. If you look at FTSE 100, you have BP, Royal Dutch Shell, BHP, Rio Tinto, and then a bunch of banks. But it's basically Australian miners, Russian potash producers, and Middle East things, and energy groups. If energy is not moving, European indices are suffering. This is what we saw. This was Q3 of 2000 this year. I looked at European earnings on a sector-by-sector basis year over year. Year over year, we had 3% earnings growth, which was really bad, underperforming the US. If you take out energy, we would have had 17% earnings growth. So we are seeing earnings acceleration in Europe, but the problem is offset by these massive losses in the energy sector. It will be very hard for Europe to get back the European indices to really perform well unless we can get a stabilization on the energy side. It will also impact dividend payments. Energy and utilities account for 34% of all dividend payments in Europe, and obviously they're going to get cut going into next year. The third, and I think more interesting reason why the cheap energy is a good argument, is bogus, has to do with this story. If you really believe that cheap oil is good for Europe, how can you explain what happened to European indices between 2002 and 2008? Here I took the relative strength of the MSCI Europe to the US. European indices outperformed by 100% over the period when oil went from 20 to 140. This is when the euro traded at 1.6 against the dollar. The pound was about 2. London real estate prices were through the roof. Everything in Europe was crazy expensive in 2008 when we had oil at 140. Even crazier, our trade balance went from a deficit to a surplus. So the cost of our biggest import is multiplied by 7, our asset prices soar, and our current account balance goes from deficit to surplus. How does that happen? 2 reasons. One is just current account flows. I looked at the elasticity of Germany to Saudi Arabia trade. Germany only imports one thing to Saudi Arabia, that's oil. When German imports from Saudi Arabia rise by $1, German exports to Saudi Arabia increase by 98 cents. So, okay, we're giving $100 a gallon, a barrel to these guys for oil. They were spending $98 back in Gucci handbags, BMW, fancy real estate, football clubs, whatever these guys have to buy. This is just on the current account side. You also need to see the financial side of the balance. The petroleum is being recycled for Europe. One way I like to think of the great commodity boom of 2000, 2010, it was like a tax that was being levied upon the world. And was being levied by one family in Saudi Arabia, a couple of corrupt oligarchs in Russia, Norwegians, they're fine, mullahs in Iran. What do these guys have in common? They were all structural buyers of European assets. The Arabs, you wouldn't even let them invest in the US even if they wanted to. The Russians, they never wanted to invest in the US. The Norwegian, they need to constantly be buying European assets because otherwise the currency would keep soaring. So whenever these guys had money coming in, it didn't stay. I mean, there's no economy in Saudi Arabia or Russia. I mean, money comes in the bank account of an oligarch and then gets immediately switched back to a bank account in Switzerland. That was that great recycling that was going on. And that's why Europe was doing so well, because we're the ultimate beneficiary of the great commodity boom. Now, if you look at the relative strength of European stocks, it peaked in 2008, right when oil peaked. And then kind of followed it all the way down. So, yes, now we only pay $40 a gallon, a barrel for oil. But on the margin, it goes to a producer in Canada or in Texas. And these guys are not going to buy, they're going to spend it back in Europe, they're going to reinvest it. And Europe is having low oil deficits, but it's not getting the recycling. And to some extent, we're paying, we hang down with the wrong kids. I mean, we tied our fate to that of Vladimir Putin and the Al-Saud family in Saudi Arabia, and we're hurting with them now. So that was oil. Third part, which I will touch very briefly, and I want to keep it for discussion, is the rise of the populists in Europe. If you go by the consensus view is that it's a crisis-related phenomenon, right? It's because austerity has been so bad in Greece that they revolt, but it's a Greek kind of idiosyncratic thing. In Spain, it's because of the history of political division between Spain and the UK, it's because they never felt in the European Union. Well, if you have something that's idiosyncratic in every country in Europe at the same time, it's no longer idiosyncratic. It is a structural movement that has been taking place for years against Europe. I mean, it's funny, every election since I'm a kid in France, people are surprised by the rise of Front National. Every election for the past 35 years. Whoa, there's nothing surprising about the rise of Front National. I mean, you plot it over time, it's just a steady increase. And that's happening in every country. That's happening in Greece with Syriza. That's happening in Greece with Spain with Podemos. That's happening in poor countries like France. It's happening in countries that are not part of the Euro, with UKIP in the UK. New Democrats in Sweden. That's happening in Scandinavia. It's all over. You have what I would call a great shift of the European political landscape between the traditional pro-Euro parties, and now the dividing line is whether you're pro-Euro, pro-globalization, pro-migration, or whether you're against Euro, against globalization, and against migrants, mostly Muslim. That becomes a dividing line of European politics. And based on trends, there's, I think, a pretty good chance that out of all the European countries, at least one of them votes one of these guys in. And I think it forces you to wonder whether the movement towards the ever closer union, the integration of European markets that we've seen for the past 50 years may have reached a high watermark, and we may be seeing the unraveling of the union, or at least a period of great instability during which Europeans figure out whether they really want an ever closer union, or whether that was just an idea among technocrats, which I think it was. That's pretty depressing. Now, one pushback I have when I do this presentation is people tell me, yeah, but the stock market is smarter than you are, which it probably is, than I am, and it's all based in the prices. Europe trades with a Sheila PE of 13, the US trades with a Sheila PE of 24. So yes, when you buy Europe, you're getting all these negative tailwinds, negative headwinds, sorry, but at the same time you're getting bargains. This is not true. The Sheila PE was developed in the US to time the US stock market. And the reason why Sheila PE works in the US is because the US is a big insular economy and earnings do normalize in the cycle. Sheila PE needs that the past 10 years are similar to the next 10 years for it to work. It was never intended to be something for country rotation. I mean, if you want to do a Sheila PE-based country rotation strategy, just buy Russia. Russia is always the cheapest on a Sheila PE basis. And if you want actually that, against the Sheila PE argument, I've actually did, well, what if you did it 10 years ago? Let's go back to 2004 and, okay, we compute a little Sheila PE, we get inflation numbers. Which European countries would you have bought? Oh, look at all this value. Portugal, Greece, Ireland. These had a Sheila PE of 13 back in 2004. This was the value in Europe. Now, what was the most expensive market? Denmark, Sheila PE of 24. Now, if you had done that on a long-short basis, you would have lost about 50% there, and shorting that, you would have been bust. The point is, Sheila PE, as I was saying, only works if earnings normalize over the cycle. In Europe, it's not going to happen. Between 2004 and 2008, European earnings were multiplied by 4. What happened? A perfect storm of good events. We had the expansion toward the east. 12 countries joined the Union. 200 million consumers were suddenly added to the common market. We still had all the European money that was flowing to Spain, building airports, highways, going into the pockets of politicians who would then spend it with their friends. We had a credit bubble. I mean, if you were Ireland just 20 years ago, nobody had a credit card. I mean, by 2006, I mean, Dublin was like the most expensive city in Europe. Everybody was spending left and right. Yields had collapsed. I mean, in Ireland, you know, yields were like double digit in the 90s. They fell all the way to like 4%. So massive credit boom, construction boom, real estate bubble that I'm not even starting to talk about. This is what inflated your earnings. So when you look at the 10-year trading earnings in Europe, you are capturing this once upon a lifetime earnings boom that completely skews your think. And I think what your Sheila PE tells you in Europe is that earnings are not coming back, not that Europe represents value. Second argument against the Europe is cheap crowd is sector composition. So this is the point that I was making earlier. This is the composition of the MSCI US index. Biggest sector in the US is information technology, 18%. In the UK, 1%, in Europe, 4%. What is Europe essentially? It's a bunch of banks, utilities, national company, the telecom company that used to be the monopoly, and then a couple of energy companies. If you took the US sector structure and apply the European PE by sector, you can construct a sector-adjusted PE for Europe that adjusts for difference in sector composition. This is where we point exactly the same level as the US. In other words, the real difference where we have about 20 in the US and 17 in Europe is nothing but an illusion and reflects the fact that Europe is heavily biased towards low-growth sectors like telecom, utilities, while the US has the world's most vibrant technology sector. On a sector-adjusted basis, even after the October correction, Europe is not cheaper than the US. And you can see it from a bottoms-up perspective. I mean, if you line up similar companies in Europe, you take Unilever and you compare it to Procter & Gamble. Unilever is not cheaper. You take SAP, you compare it to Oracle, same. Sanofi versus Merck, if you look at the kind of global, big quality exporter names, they're just as expensive in Europe. The value in Europe is really just an illusion because you have a couple of very large banks that trade at very low multiples because people have very rational doubts on the quality of the balance sheet. Now, what worries me about Europe, other than what I already said? Here, I looked at the flows into, I guess that would be the ETFs that you guys would use to invest in Europe. EWU, EWP, I took the big Europe equity ETF, BGK, the iShares and Vanguard. Like, you're a US asset allocator, you want exposure to Europe, that's what you will find. So I look at the flows. You can see that for most of the debt crisis, nobody wanted to do anything with Europe. And I saw that with my funds, things really changed back in the second half of 2013. Suddenly, Europe was cool again. Europe was coming out of recession, QE maybe would be out. Basically, people started getting this idea in their head that Europe was the US with a four-year lag. So all the people who had missed the 2000 bottom, which is probably everybody, thought, okay, I get my second chance here. I'm not going to miss that one, and I'm going to invest in Europe. So we see about $50 billion go into these ETFs in the space of 6 months. Not that much has come out yet. I mean, this is since October. There's still a lot of money there, and this money is not pretty. I mean, if you went into Europe in 2013, late 2013, basically the index is flat, and you're a US dollar-based investor, you're down about 14%. The question is, how long do you want to keep that, are you going to keep that loss? And how long are you going to justify to your client, yeah, well, the S&P 500 is at a record high, but, I bought some shares in Telefonica, and my impression about US investors from doing this job is that the more retail you go, the more buyers they are. They want nothing more but just buy the Dow Jones for you, like they really love the companies, they see the name on the street. The only reason that US investors ever look at Europe is because their financial advisors tell them about mean variance optimization, Markowitz, all that stuff. Like, you don't like it, but it's good for you. It's kind of like broccoli. So let's look at what good old Markowitz would have told us lately. So here I look at the efficient frontier between the 6 MSCI equity region, and I set it up since June 6, 2012. Why June 6? Because it was the day that the Greek election happened, and that's the day when Spain and Greece made a bottom. It was the most favorable point to invest in Europe. Like if you had perfect science, you would know that Draghi would do all that and Europe would rally. What should you have done over the past 6 years? Put 80% of your money in US equities, 0 in Europe. Even if you time European bottom perfectly, the efficient frontier doesn't cross Europe stocks. You'd go a little bit into Japan, Pacific Asia, but Europe, because of its crazy variance and relatively high correlation to the US on a risk-adjusted basis, you wouldn't have in the left side. So even the last result argument for Europe, which held that the diversification doesn't really hold, at least hasn't held for the past 2 years. Now, other counter-argument I hear is, but you just wait, QE is going to happen, and it's going to change everything, and Abenomics, Koruda, look at Japan, whatever, blah blah blah. It's too late. There was an auction yesterday for the German 5-year Bund, which priced at minus 11 basis points. Good luck with getting that down, Mario Draghi. I mean, we've already hit the zero bound limit in Europe. I mean, rates for all practical purposes are already at 0. Germany for 20 years is at about 30 basis points. Switzerland is at 10 basis points. Even the periphery is at 150 basis points. And the problem is that the real rates are actually quite high. If you look at, take the 10-year bond yield in Italy, minus the inflation rate, you have a real yield of 2%. Japan, that's successful trashing of the currency and successful rip-off of the savers. Like they really managed to get the real yield much, much very negative. But in Europe, you can't do that because you already have deflation and your yields are already at zero. So we are already in a liquidity trap in Europe. The second reason, and I'm going to switch, I'm going to skip that and I'm going to go here, is what I was hinting earlier was that this is not a liquidity problem. QE works if you have suddenly a lack of liquidity and then the ECB floods it and the central bank floods it, everybody has it. In Europe, the reason banks are not lending is not because they don't have money. You want money in Europe? You can get it. There's an alphabet soup of programs to get it. LTRO, MRO, TLTRO, ABSP, ABSP2, CBSP1, CBSP2, ELA. All of that will get you money if your European banks have anywhere between 0 and 75 basis points. Yet lending is not picking up. Why is that? Because of this. This is the value of non-performing loans held by Italian banks, nominal value. And this, in a surprising display of honesty, the Italians also report the market value of their non-performing loans. So, cultural stereotypes are not always. Anyway, 180 billion euros in non-performing loans. The Italian banking sector has a little under 500 billion euros in Tier 1 capital. A third of your Tier 1 capital is tied into non-performing assets. And what's happening to these non-performing assets? One, there's more of them, and two, the quality is degrading. So your pipeline grows, and then the very assets that you have are crappier. And this, to me, is the failure of the first approach, the 2011-2012 approach to the crisis has failed. The idea, and it was very smart at the time, was we ended in 2011 with a problem that private investors wouldn't swallow Greek or Italian debt anymore. We needed to find a buyer for this debt. Now, we had a problem because the ECB couldn't buy it because we have the ECB charter. Mario Draghi is a smart guy. So it's like, well, I can't buy the debt, but I can give banks the money so that they buy the debt for me. That was LTRO. We gave European banks, and by European I mean 4 Italian banks and a couple of Spanish banks, €1 trillion. And we told them, here's €1 trillion for free, or 75 basis points. Please invest them, and then it's at 7% and make a carry trade of €70 billion a year. Now the banks, initially, they were like, nah. Because they were worried that the yields would move against them. So the ECB had to come back 2 months later with the whatever it takes policy. Mario Draghi said, by the way, if the Italian yields move higher, I'm going to buy these things. So there was a put option. €1 trillion in free capital, 700 basis point in carry trade, and a free put option. I'll do it. It was genius. Not a single tax dollar has been spent. It was a bailout. I mean, every year these guys were making 70 billion on just the carry. So over 3 years, that was a significant bailout. And basically, and Draghi was telling them, okay, I'm going to have stress tests, but I'm going to push them out in 2014, so I'll give you time.